A very warm welcome to the Growth Trajectory. I'm Nadine Blaney from AusBiz. Well, there was once a time that listed companies were going for growth, sometimes at all costs. But then rates rose and the market was punishing companies that were unprofitable or had no timeline to get cash flow break even. But as you well know, nothing stops the sands of time, so some, not nearly all, but some companies have done the hard yards, cutting costs, proving up technology, and positioning themselves for profitable growth. And in some cases, the proof came through in the last reporting season. Well, today we'll be hearing from leaders of Bravura Solutions, Life360s, and Polynovo. One's a turnaround, profitable once again or nearly. One's just profitable at the adjusted earnings level. And one company's chairman says that profit is just a nice to have. And while the company was profitable in the half, he says it's not the be all and end all. I'll let you be the judge. Actually, on that, now would be a good time to introduce my guest, Joshua Barker from Maqro Capital, our presenting partner for this event. Hi, Josh. Good to have you here.
Yeah, thanks for having me. Excited
All
to
right.
be here.
So let's start with my assertion that growth companies fared well, perhaps unexpectedly well this reporting season. You know, am I wrong, or is there some truth to that?
Yeah, look, it's a thematic that's been shifting over the last maybe 12 to 18 months, where we've seen massive layoffs come from tech companies globally. So, the numbers that were coming through each quarter were doubling for number of employees laid off in the tech sector. And it's not something that, necessarily has an immediate impact on companies' balance sheets switching over to profitability. And it took a lot of companies to get on board with that change, implement that change, and then for it to flow through. So we did see a little bit of it from some of the market leaders or the early adopters of this strategy in the last reporting season, but we saw a lot of it this reporting season, and it seemed that shareholders really rewarded companies that have successfully made that switch, and the share prices reflect that.
When you cut costs, when you cut people, does that necessarily impact the ability of that company to continue to grow?
Yeah, it's really interesting. So there's some companies out there that are growing revenues despite the cost-cutting measures that they've gone on and resulted in earnings positives. But there are some that have flatlined or potentially taken a pretty large hit in revenues. Particularly, one of the big costs that they're reducing as well is marketing, not only employees but marketing as well. So you can see how it would cause a bit of a drop in the top line figures, but it doesn't necessarily mean that it's such a bad thing. I think investors are rewarding the bottom line figures more than the top line figures at the moment. So the previous growth at all costs has really shifted, and it will probably start to shift back. And those companies that can grow revenues while still remaining those tight balance sheets are going to be obviously really, really strong for investors.
Okay, so investors need to look at top line versus bottom line growth and how the sort of change that these companies have had to implement impact their results. Okay, so that's a bit on how reporting season was for some of these companies, and we'll talk companies obviously throughout this event specifically, and we'll get Josh's view as well on what companies they favor there at Maqro toward the end of this event. But generally speaking, what is your view on adding growth to the portfolio? Because of course, things are cyclical. We go through these phases where it's, awesome, add growth. Then we value, then what's your current state when it comes to adding growth?
Well, we've been in a cycle where there's been a lot of uncertainty, particularly with the rising rates and inflation. So we've erred on the side over the last 12 to 18 months of larger companies providing that stability, just as we were unsure about the economic impacts that would occur and whether rates would come off and whether we'd achieve this soft landing. It does seem like that's the case, that we're going to enter if we can get rates to come off, with inflation coming off first before economic growth really starts to get impacted. So if we can navigate through that just in the short term, it's going to create a very strong bull market with those rate cuts coming through over the next couple of years. So it's the perfect time to start your research into those growth names. It's the perfect time to even start to allocate into, and that's the approach that we're looking at the moment. Valuations on the top end of town, particularly here in Australia, it's true in the US as well with the Magnificent Seven returns, they're very saturated, and those were the first movers. Now probably what we believe we'll see is capital flow down the market cap, go to the mid caps, and then obviously the small caps that looking for more of that growth on a relative valuation.
Okay, maybe I need to take a step back then and ask you what qualities, what characteristics do you look for in a growth company?
Yeah, obviously the key one is growth in revenues. We've seen a lot of companies make that switch to earnings. So the earnings growing is really important for us. The interesting part is I guess the companies that have the monopoly or even a market leader, for example, if they were able to make the switch to profitability, their revenues kept going because they're a market leader. They have very strong market share or potentially increasing market share. A really good example of that is some of the platform funds under administration providers like a NetWealth or a Hub24. Those guys, no, they're not market leaders right now, but they're on their way. They're picking up more and more market share. So finding those unique value propositions in the market where the company's still growing market share, really strong management is always important to us. Companies looking to that are going to be really growing throughout the next period as well. Not just the numbers currently, but are well positioned to grow into the future as well.
Do they have to be profitable? Net profitable, adjusted earnings profit, or do they just have to be on a path to that whilst growing revenues?
Yeah, again, it depends on how early you want to be on it. So how I spoke about rolling down the market cap. You could take your time with that. You could roll out of your CBA at 120s and pick up maybe a mid cap, then eventually roll out of that into a small cap, or you can go more aggressive and straight into those smaller names. So obviously you're going to have a little bit more certainty in the companies that have already executed on that or have indicated in their guidance in particular that they're going to achieve that in the next financial year. You've got a little bit more surety. That's probably soaked into the share price a little bit. So you're obviously not able to get that such quite bargains that you would typically by maybe anticipating which ones are going to do it. You probably want to have a very good understanding of management's ability to execute if you're going to anticipate that they will pull that off. But we've preferred companies over the last 6 months, probably in the last reporting season, that have already made that switch. Obviously the valuations in those, the market leaders like real estate and Xero, the valuations have come up really aggressively already on those. And then you've got names probably in the midpoint where we're starting to see that share price reflect it, like a Megaport, which is already just done the sort of cash flow positive. And this report we saw a big uptick in the cash flows. So I think you're sort of erring onto that side of companies that have just done it is I guess probably the sweet spot for us.
Yeah. Okay. Interesting. Now, what characteristics? So you mentioned Xero, REA Group, Megaport as companies that have done it well. What are characteristics of a so-called growth company that would make you just avoid it? Too early, too soon, or not proved up?
Yeah, look, it's the inability to be able to cut those costs. So some of the more traditional or older businesses that are potentially stuck in their ways, like financials, old established financial firms, for example, fund managers, they don't have that sort of aggressive cutting in employees and the ability to use technology to replace the workload of those potential employees. So if they're stuck with their costs and the revenues shrink, they're in a spot where it can't possibly be done. So those are the names we're avoiding without that sort of maneuverability to change the cost structures and even revenues.
When the small end of town, this is a bit cheeky, but is it a red flag when you see small companies touting their adoption of AI or lithium or uranium or whatever is sort of flavor of the month?
I guess it depends on how small you go. Obviously, extremely small, yes, because they haven't got anything to prove that, or they haven't got a mine where they've validated that, or they haven't really got the actual technology to implement the AI, for example, and just using it as more of a buzzword, which, I mean, there's not many companies out there that are not using AI as a buzzword, from the top end of town to the bottom. So, if you ruled that out as a general rule, you probably wouldn't have much of a portfolio. So, yeah, always wary of companies that jump on fabs. But companies that are established and have done well in the past can really use that to their advantage for sure.
All right. Look, let's hear from the first company of the session, Bravura Solutions. Now, it's not really an exaggeration to say this company was on its knees. The share price dropped 30% in early 2023 after it posted a loss. It had to raise capital at a heavily discounted price. In fact, at the time, I recall, it was called a rescue raise by some. And there was a lot of instability in the C-suite as well. Something was pretty wrong at Bravura. However, in this past reporting season, it really looked to be turning things around. In fact, it looks to be shaping up as a classic turnaround story. Its share price going from 34 cents a year ago to $1.40-ish last time I looked, and it's back to EBIT profitability. So we caught up with CEO Andrew Russell, and we asked what he was dealing with exactly when he took the helm in mid-2023.
Well, it was certainly an interesting time when I joined the business, and there'd been just a capital raise of 80 million. There was certainly problems in terms of the business was making significant losses, and that was just unsustainable. We had clients that were quite concerned, and indeed staff quite concerned. But the fundamentals of the business remain strong because we've got great technology, we've got blue chip clients, and we've got great people. So that's a very good starting block to set your journey of turning the business around. And the way that I look at it, it's just very simple. Just get back to basics and focus on the fundamentals. And that's what we've done. And we've sorted that through by focusing on 4 key areas, which is just aligning our business around our core and going deep as we possibly can into our markets and clients. We focus on our key strengths, which is our technology. Ensuring that we're client focused. It's just another simple thing, but that's very important. And then building a quality business and just rebuilding trust across our clients and across our staff. And if you do all of that, you'll rebuild shareholder value.
You make it sound so terribly simple, but as we know, there's often a few, potential challenges along the way. So was it a case of not only getting to know the clients better, getting to know their needs better, were there unnecessary costs sitting in the business that had to be stripped out?
Well, I think that's the first thing, that when you come into a situation that I came into, you've got to focus on really understanding and listening, and listening to your clients. And we spent a lot of time just understanding where they were with us and the history of their relationship with the business. And that gave me great insights in terms of the immediate things that I needed to do. Internally, to be able to create a transformation as well, you've got to bring the team along, and you've got to explain the why, particularly when you're going through a process of cutting costs materially to get the business back to profitability, because that's the key thing. If you're a software supplier, you have to be profitable for you to be a long-term sustainable business. And that's pretty much the process that we went forward, but basically explaining each time the decisions that we're making across the business, and that started to bring the team along. Then for our clients, that they could see that we had a sensible plan. They knew that we had some difficulties, but once again, the fundamentals of our technology were working well. So it's a combination of working with those two aspects.
That's really interesting. I love the fact that you've touched on something, and I think investors sometimes miss, which is culture. And culture of a company, and what makes a great company is a great culture. And you've talked about there of taking your employees as well as your clients on the journey of how you turn around the business. Is that an integral part of when you're turning around business, that you're actually reorientating the cultural ship as well as other drivers of the business?
I think it's the epicenter of being able to get the change at the pace that you want. Going through the situation that Bravura was in, it was quite grim at that point in time. So regular and honest communication, both to your clients and to your staff, is mission critical. And they realise if you're not telling the truth or manipulating the situation in a bad situation, but calling it out, but then not only identifying the problem, but having a pathway to improve the situation. And then them obviously giving you some leeway, as well as the market, to be able to execute against that. And luckily, we've been able to do that so far.
Okay, so just looking at those half-yearly results, you've more than stabilised the ship. So EBIT earnings was 7.9 million, up 11.5 million on the previous corresponding period. So once you've stabilised the ship, how do you then accelerate its trajectory?
Well, that's another big $1 million question, but I think that it comes back down to the fundamentals of Bravura, that we have got market-leading technology, and as I said before, great people. What we've been able to do is stabilise the business because our cost base was just too high. Now, once we've got rebuilding some shareholder value and we're building trust within our client base, we can start talk about things about how we can work together in a partnership to grow your business using our technology, which will eventually feed through to growing our revenues. And that will be our focus in FY25.
Is it a case of being able to embed more of Bravura's software solutions into existing businesses, or maybe just also looking to expand into new clients, or is it a combination of both?
I think it's a combination for our two businesses because we operate in two markets, in the EMEA market and APAC. And one of the reasons why we realigned our business around those markets, because our customers are different and the life cycle of our businesses are at different stages. We're very mature in the EMEA region, so we think that there's a great opportunity of basically just sitting down with our clients, listening to their strategic plans, working out product roadmaps, and then growing in line with them. In the APAC region, we've still got lots of work to do. We've got some great clients here, and I believe that there's some really good opportunities for us now that we've got a stable base. We're proving out what we're saying that we're going to do with the business and look for opportunities to grow.
Do you put in place internal growth targets in terms of, acceleration of revenue and the like? Is that part of the process to achieve earnings growth?
I think for this year, it was getting us back to profitability, and that was the mantra internally, and that was we explaining why for our clients and for our staff, and then consequently people get aligned with the share price. We talk about targeting cash EBITDA margins. We want to have a profitable business. We're pleased to see that we're ahead of our schedule, and for this year, we're saying that we're going to be growing our margins in the second half, cash EBITDA positive margins, and then growing it further in FY26 and 25 and 26.
Can you give us some shape around those margins, what you're looking for?
Well, I think that if you benchmark to world-class software businesses, and we've got a long way to go, they're operating at 20% plus. And I'm not saying that we're going to be there just yet, but that's the ambition for management. And if we exit this year at 8% with the work that we've done, and then the bow wave of the changes that we've made across the business start to float through for 24 and 25 and 26, we certainly are in good shape to start to dream about meeting those margins.
Once the cash flow starts to be generated, do you feel that you will be looking to invest more into the existing technologies?
I think that we're continually investing in our technologies, and you can't sit still, even though we've got a very strong market position. I think our approach is to really align the investment decisions with what our clients are doing. We know that our strengths. We also know where we've fallen short. I think that our ambition is just to ensure that we're listening and in investing correctly with our shareholders and with our clients.
I had a quick peek at the share price, and it has been going in the right direction. How much pressure is applied by investors to Bravura to get improved performance out of the share price?
Well, I think that we needed to rebuild shareholder trust, particularly when the share price had gone in the opposite direction at a fast pace the previous years. So that was the first point. But the fact for us is really just focusing back on those fundamentals, taking the cost out of the business, focusing on cash EBITDA margins, looking at ways that we can be better client focused and focus on our regions, and then the share price should take care of itself.
Absolutely. And in terms of aiming to improve your cash flow generation, I guess an outside analyst might say it's about improving the quality of the earnings for the company. And if that's achieved, then the valuation will also increase. Are those type of things, do they feature in your mind at all, or you're really on the nuts and bolts of maintaining that culture, improving it, building the business as you've described it?
I think it's just the stages of where you are in the life cycle of the business. So there's been a fair bit of heavy lifting over the last 12 months to get the business back to profitability. There's been a fair bit of immediate focus that you're not looking too far down the track because that's your immediate goal. A lot of communication, as I outlined to clients and staff. But once you get to that point, and we're starting to see some green shoots, we're not out of the woods yet, but we can see some blue sky, which is really refreshing. My job then is to start to really focus on thinking of the next horizon, year 2, year 3, and how we can take this business forward, but still remaining on the fundamentals of clients and technology delivery.
Andrew, what skill sets do you think you bring to the business, given your amazing career that you've had? You mentioned to me you've been with Class, you've been with REA, you're across software businesses. So what are some of the things you have added, do you think, to Bravura?
Well, I hope that I've been able to impart a strategic mindset, a client focus, particularly across the team, and engagement. And one of the strengths that I hope that I bring is the ability to be able to communicate the why. And I'm enthusiastic about everything that I do in terms of the choices that I make from a career perspective. I'm very passionate about Bravura, and I believe it is a great business. And I'm hoping that energy is contagious for our team and for our clients. And if it is, I think we'll be in some good shape. And
one last question, because we do spend so much time talking about interest rates and economies and things. Have you seen any negative, or I suppose, headwinds from a potential slowdown in economies?
Well, we called out in our half-year results, we're certainly seeing some headwinds in the EMEA region, particularly as some of the larger institutions are also going through their cost cuttings, which has an impact downstream on our professional services revenue. So we see that, but how long it's going to be, we're not too sure, but we certainly are mindful that could impact revenues. Certainly 70% of our earnings are denominated in Europe. So we do have currency risk, and there's lots going on in the world at the moment, isn't there? So we've also got to have an eye on that.
Absolutely. And just to reiterate what outlook you've provided, if any, or guidance?
So we've upgraded our guidance to 18 to 22 million EBITDA for FY24.
All right, that was the CEO of Bravura Solutions, Andrew Russell, and I'm here with Josh Barker from Maqro Capital. So excuse my English, but what do you think of Bravura?
I think this is probably the perfect example of what we're looking to focus on here. It's a company that was, in a very big cash burn state. They've managed to successfully switch that to cash flow positive, and I think the way that Andrew has done that is been really good from a culture point of view. So he's really focused on that being the priority to staff. But also to its customers, which I thought was quite interesting there. Not only, I guess, the focus being on the cost cutting, but also the profits that come with that, and less so on actually the revenue growth. So, Bravura, for example, has had flat revenue growth, and you can kind of infer that they're happy with that as long as those cost cuttings are coming through. So, I mentioned briefly at the end that they're upgrading their earnings, and that comes from upgrading their cost cutting measures. So, I think they were about 40 million annualized, and that was increased to about 65 expected now. So they're listening to the market, and I think the share price is supporting them in that way as well. And they're giving very regular updates about their cost cutting, and they're doing it ahead of schedule, even ahead of their own schedule. So maybe being somewhat conservative with how aggressive they could go with those cuts and what that's going to mean for earnings, but then working really hard to beat that. And I think he's done a really good job of aligning the entire business with that strategy, which I think is really important. Moving forward, obviously, once those earnings and cash flows start to play an uptick, then the business collectively, from consumers to clients and employees, management too, can focus on growing the revenues, and that will only lead to more earnings. So, yeah, great example, and I think a company that's showing management really mature in executing that.
Yeah, I was going to say, if management is key, it seems that you're endorsing the strategy that's being employed by Andrew Russell at this time. But we did mention that the share price has recovered, not to where it has been in the past. But so is this a company that you think has proved its mettle enough when it comes to that transformation, where you can still see some upside coming from here?
Yeah, definitely. I think that the fact that they've continued to beat and upgrade their earnings guidance, we'd now put them in the category of being in an upgrade cycle, which is always strong. Also, they've been in a pretty precarious time for the share price. So again, you're talking about a break of downtrend from an investment point of view. So things look quite positive from this business's point of view. They've managed to maintain those revenues. So now they can focus on, potentially increasing those as those cost cuts come through as well.
All right, so Bravura Solutions, an example. BVS is the ticker code for those not in the know of a company that is in the midst of a turnaround, getting back to profitable growth. And of course, we'll hear some other companies from Josh in just a bit. But another ASX listed company that has come to the party this past reporting season in particular, Life360. It is a family tracking app, and shares, let's be honest, have been on a tear since it reported. It was profitable on an adjusted earnings basis. But also, what helped the share price rise with the news that it's looking to monetize its non-paying user base through advertising. The market is treating Life360 like it is a better quality business than most nearly profitable tech companies listed here. I spoke with CEO Chris Hulls and began by asking him what this inflection point means to him in the business.
In our perspective, this is not anything new. We have just done what we've said we're going to do. We have long said, hey, we grow organically. We have very low customer acquisition costs. Our costs scale sublinearly because we're a software product. So if we double our user base, our costs do not go up by a commensurate amount. So I think what happened with this earnings is really across the board, we started to show the financial leverage that we internally knew we could put into the business, but now we've actually proven it with numbers. And we've had some very good tests that shows that we have some opportunities to monetize the users who don't pay us. So indirect monetization through things like advertising and lead gen, which I think the market really got excited about. And I think we have been overlooked because at times people sometimes dismiss us as an app. But if you look what we really have, 61 million active users, 15th biggest app in the country by DAU, it's really more of a platform play. And I think that's what investors are starting to understand.
Yeah, all right. It does remind me of an interview we did probably a year and a half ago when you said you were confident you had levers that you could pull to get yourself toward that cash flow break-even point. So I said inflection, just to be clear for our viewers, because you've hit adjusted EBITDA positive in the most recent half. So US $20.6 million. So Chris, is it fair to say then you have done the hard work in terms of cost control, in terms of restructuring?
Yeah, we did that. So we did a reorg about a year ago. A little bit painful, but it was also a bit of a reorganization in the Valley. And I think that although it's always challenging when belts are tightened, it's good discipline. And when you do it with other companies, it's part of a shift in the zeitgeist. And to the point of this interview, many companies were dependent on ZERP type growth where user acquisition is being subsidized, margins were being subsidized, unit economics were negative, but were going on the bet that they would get better. And as the tide went out, some companies like ourselves, we were able to show that it really wasn't that hard for us to make some of these basic changes to hit the numbers that investors are hoping to see. So we did a reorg. We pulled back about 15% of staff, again, painful, but it was good discipline in general. And it let us reprioritize on the things that were very more focused on generating leverage early on. But we did not have to change a whole lot because, as we mentioned, most of our growth is organic and our margins have always been very high. And we have huge demographic tailwinds. So we are an app to manage your family. The first generation that is digitally native, millennials, are now aging into our segment with having kids getting smartphones. And so it really is giving us a great tailwind, because we've been seeing actually the regions with our highest penetration have been growing faster than less penetrated regions, showing we really have a long way to grow.
Yeah, on that, because I know probably last year you invested in more senior leadership when it comes to the international business, really putting a focus on that. So is that paying dividends?
Absolutely. So international growth had higher growth in the US because there's still low-hanging fruit there. I think it was something like close to 40% growth in UK and Australia. We now have launched our premium product in the UK. And another thing that was clear this earnings was that the international strategy is paying off. And although we're a US company, from a population standpoint, the United States is only 5% of the global population. So clearly some regions are going to monetize better than others. But our product was all about keeping you close to the ones you love, safety for your kids. It's a really universal value proposition that transcends all borders and socioeconomic classes.
So Chris, do you think it's easy to forecast subscribers, but importantly as well, to forecast what non-paying subscribers are likely to become paying subscribers in time?
So we have very consistent growth through COVID, through the downturn. Aside from very short periods, we have become quite easy to forecast. One of the blessings of organic is users just come, and they have multiple seasons now where you can see the curve by which it happens. And outside of 2020, which was obviously a mess for businesses like ours in the pandemic, it's been very reliable. So a couple of things we look for: do we have the big bump in Q3 when kids go back to school? Do we see a big spike in downloads after Christmas when kids get new phones and Life 360 is installed? We have seen that like clockwork for almost a decade now. So although organic really is hard to influence directly, we just have to build a good product and get our brand out there. It has been very predictable, and subscriptions in particular, it's not like a restaurant where if you close the doors, revenue goes off overnight. We're subscription, so it's extremely stable and predictable. It's arguably the most predictable type of business out there because you know exactly what people are going to pay every month, and you're not having to refill the funnel every single period.
Yeah, and you're predicting or forecasting for subscription revenue growth of at least 20% and adjusted earnings of between $30 to $35 million a K. So I had to read that off my sheet. When it comes to this new advertising business that the market's very excited about, clearly, that is a way to monetize your non-paying subscribers. So are the costs of setting this up significant? Have those startup costs, anything associated with it been included in that guidance?
They're all included. It's quite low. So in general, with advertising, it's not like a brand new product initiative where we have to invest for multiple years out before we see the return. We can do small early tests that actually are profitable. And as we get success, spend more. So the reason we hadn't done advertising sooner is, in general, we like to expand what our product offers for customers. But we've always known that advertising is a high leverage way of making money. We've seen businesses like Uber go from zero to forecasting almost $1 billion a year of advertising revenue in just a few years. You've seen Reddit, you've seen Netflix, you've seen DoorDash, you've seen Duolingo. All these companies have outsized success with advertising, and that did give us a lot of confidence that we should be able to do the same too. And that's what triggered us to run some of these early tests. It says, yeah, you really can do this quickly and immediately be contribution margin profitable with huge upside. So we're very excited that we do have this lever to pull. Only about 1 in 6 of our customers pay us directly. So if we were able to get just 1/6 of the monetization, that essentially could mean our indirect and advertising and lead gen revenue could equal all the subscription revenue in totality. And I think investors saw that it's really not that many things have to happen for us to become a business probably 10x our value. International is going well and growing quickly. Our subs monetization is improving. We have demographic tailwinds. We're now cash flow break even. And we have this whole new business line, which we're highly confident will be paying a positive contribution margin in literally the first year of launch. So to your point on an inflection point, I think all those things tied together with cash flow break even is really helping that story come to life.
Yeah, and Chris, when you think about the time and the effort that you've spent bringing Life 360 to this point, along with your team, obviously, but do you look at something like this advertising idea and think, God, I wish I would have thought of that sooner?
No, it's not a new idea for us. We had thought of it, but again, we were very intentional about our model. So another example, we are a freemium business. Freemium businesses are high risk until they get to scale, but once they get to scale, they're very hard to unseat because how is someone going to undercut you? And so we wanted to first get the user base, then we wanted a premium product that people love that would make money, and then we wanted to move into advertising because in general, we've really thought about how do we add value in what we give to our customers. And advertising, I don't think it's going to hurt our customers, but it doesn't give us the same defensibility of actually adding to that core. So it's really a balance of doing both. So now we have about 10% of our company adding to these new revenue lines, and we're doing it in a very user-friendly way. But I see it as just executing on the strategy that we've long laid out. And we did bring this a little bit forward, given the market environments and given some of the success we're seeing from our peers.
Mm-hmm. Okay, so just at risk of you making this all seem very or too easy, Chris, I mean, where are the sort of, pain points or challenges that you still see facing the business as you change to this next phase of profitable growth? You know, your adjusted earnings were profitable, but if net profitability is the goal, how do you do that? What sort of worries you on that path?
I am genuinely not worried about getting profitable. I am convinced if we need to declare $100 million to the bottom line next year, we could do it. It would not be that hard. It's because we're investing so much for the future. So I think one of the things that has been challenging, though, is for a business like ours that has so much growth potential, in many ways, the right move would not be to be getting to profitability, it would be to invest in growth. So how do you thread that needle in a market like this? And I think we've done a good job there, and the market is rewarding it because we have really said, hey, we're going to be a user-centric company, but when the time's right, we'll be able to flip to profitability. I think we've always had our skeptics, and some of the interviews I've done on local media, you can see people have felt that we might not be able to pull some of these levers and get these economies of scale. So when I really think about the risk of the business, it's continuing to build value for our free customers. But truly, there's not a single company in history that has been able to build a critical mass of engaged users that has not been able to monetize. So that really is our long game. How do we make sure we stay relevant? How do we make sure as family needs evolve, our product evolves? How do we make sure we don't go too far to harvesting our customers? Because we truly believe there is a chance that we could have a billion active users one day. I'm not saying that will happen, but it's a real possibility. You see some states in the United States where you have close to 25% penetration. We're nowhere close to that elsewhere. So this is truly a product that has universal appeal. And that's both the prize we're going after, but also the risk is that we lose sight of what really gives us that defensibility and why people love us, and it's that core free product.
So that was Life360 CEO Chris Hulls there, playing the long game. I'm here with Josh Barker from Maqro Capital. Uber confident, talked about those levers that he could pull.
Yeah.
I mean, has he proved that he's got a point?
Well, the company share price has really been showing that. It's back to the sort of 2021 highs, which is not many sort of Aussie tech companies can necessarily say that. But, you know, it was a reflection of the market, not necessarily the strength of the business, but the market conditions at the time as to why it was going down in that period instead of, just the continued growth that I guess maybe the company probably thought it should have been on. But again, that's the story we've been talking about. We've been talking about how these tech companies were sold off when they didn't have those profitabilities because of the macroeconomic concerns of the rising interest rates. Again, fortunately, this company, I spoke about the negatives of companies not being able to do this switch. Chris was obviously very comfortable that he could do that at any time, and he sort of has chosen now to do it rather than a little bit sooner. But, if he had done it sooner, maybe the share price would have been probably not bottomed as much and gone back up to where it is now and would have been higher potentially. So, it's a prime example of a company that can make the switch, but potentially probably didn't do it as soon as, a company like a realestate.com did, which hit all-time highs well ahead of schedule. But I don't think any Aussie tech companies were really immune to this sell-off. And that's where being in great companies is important, but being in great companies at the right time depending on the situation is as well.
Now, for the viewers, I mean, we have a lot of terminology that's thrown at us through reporting season, EBITDA, adjusted EBITDA, net profit. Like we don't have time, nor should we, because we've got a very educated audience out there to go into all the minutiae. But I did point out that this was an adjusted earnings positive result, and part of that was $38 million in stock-based compensation. So it took out that stock-based compensation. Does that sort of accounting, and there's nothing wrong with that accounting, it's declared, but does that cloud your view, or is there a certain type of profitability that you would prefer?
Yeah, sometimes you do need to strip out those sort of things. I think the cash burn is a really interesting one. At the end of the day, it's the cash account that's going to make this business not necessarily survive, but not have to raise further capital for any accounting methods. So that's probably more important at this particular time, is to have that cash flow increasing, the cash, quarter on quarter, month on month, increasing the war chest of the business as well. So, yeah, I think EBITDA is always a popular one, but for understanding a business and the environment they're in, cash flow is king.
Got it. Now, that's probably a good time for our first viewer question. I know that these viewer questions have come in, and we did have some submitted ahead of time as well. So let's go to Simon's. And he points out that expert guests on AusBiz have previously, mentioned the quality of some earnings as opposed to others. He says that cash flow positivity can be subjective, with management adding back various expenses which, they didn't see as genuine, and some experts don't see as genuine. So he's interested to know what or if there is a definition of cash flow positivity and any add backs that are deemed to be acceptable.
Yeah, so it's interesting. If we try to, obviously the share market's, a forward-looking indicator, and right now we're talking about cost cutting because we're going through the reporting season that's, based on the last 6 months as well. So, eventually we'll probably move to a state where a lot of these cash flow positive businesses can start to add back in those costs. And I think there's good costs and there's bad costs. And I think during that massive run after COVID, when we had emergency rates in 2021 and extended through, there wasn't such an importance on what's a necessary cost and what's a not. Everything was kind of thrown. Hiring was at an all-time high. Great for unemployment, but not great for company profits. So marketing, brand awareness marketing was also pretty abundant. Every sort of fintech company was out there marketing pretty strongly and not necessarily getting a, ROI that can be measured from those marketing campaigns. So that's had to be reduced. I think given what we spoke about earlier with the revenues looking to increase and earnings with that, tech businesses can start to add on expenses in the right ways. So, personnel is an interesting one. If you're adding personnel that's going to grow the business, great. If you're adding personnel just for the sake of, making life a little bit easier, or potentially not adopting a technology that could potentially do that job as well. So that needs to be one. And I think smart marketing can be added back on when the timing is right. So, marketing campaigns that lead to higher market share in the particular area, rather than just sort of brand awareness, guerrilla marketing, or whatever it may be.
All right, and just because we're on questions coming from the audience, thank you. Jerome says, how do you find growth stocks that turn into dividend paying stocks? Perhaps difficult one to answer in just a bit, but that's the thing. None of these companies are really paying dividends, are they?
No, and I think it comes down to management's priorities. So, we just had Chris Holes from Life 360 following his earnings. I think it was on the AusBiz show. He came on and he was asked whether they're going to start paying a dividend, and he quashed that down pretty quickly. He said he's not done growing. He just spoke about his plans to have 1 billion users potentially. He's obviously a pretty high operator. He's done what he said he's going to do. So, it's pretty likely that he does end up pulling that 1 billion users off, more likely than not anyway. So I think that those sort of management language, and they'll give you a really good indication of their past track record. So, Life 360, there's no immediate plans for it to turn into a dividend stock. However, on the other side, you've got names like management of Soul Patterson's and Brickworks and Seven West Group, for example, that are dedicated to increasing their dividend every 6 months, pretty much. So you'll get an indication from management. CSL came under a bit of criticism recently in their report not too long ago, about 6 months ago it would have been, where they came out and said to Aussie investors that they're never going to be a dividend stock. That's one of the largest ASX companies on the market, and they have no plans to be a high yielding dividend play. So it doesn't necessarily mean market cap or size. I think it's really just comes down to management's priorities.
And then you have to obviously consider your own goals and personal circumstances, which of course that's not what we're addressing right now. This is information only, it's not financial advice. Just before we drop 360 altogether, one question I asked at the end, but I didn't leave it in just for the matter of time, was asking Chris, he was talking to us from Silicon Valley, whether they would pursue a dual listing, and he basically said, of course, they're constantly looking for windows to pursue a dual listing in the United States. So is that a positive for shareholders in these growth companies?
Yeah, obviously it opens up a lot more capital over in the US, but it can be somewhat of a double-edged sword. So you've got that extra capital or greater capital, but you've also got greater expectations. So there's a lot of quality tech businesses on the NASDAQ or in the US market in general that they're doing really well. And here in Australia, we don't have a lot of options. We have some really great companies, but a lot of it's been really amalgamated. So, there are higher PEs that are given to our really strong Aussie tech companies. And sometimes, US investors, because they've sport for choice, they may not justify such a high valuation. But that being said, if Life 360 can kick the goals that it thinks it can, I don't think that'll matter.
Okay.
And it'll be
just finally on Life 360, we have seen this share price rise post-report. Is it too late to get into Life 360? If they're heading toward potentially 1 billion users.
Yeah, I think so. I think it's still good for a small amount. It's one you can try to buy on weakness if it does come, but one that's, you're buying it at the highs as well. So yeah, any weakness, you're buying a quality company in this one.
Got it. All right. Josh will answer more of your questions and give you his growth stock recommendations after we hear from PolyNovo chair David Williams. In a well-flagged result to the market, P&V posted a profit. It's a burns treatment biotech, which is commercializing its product right now, right around the globe. So I spoke with David just a short time ago, and I began by asking him about a line in the results announcement, which I thought was really interesting. He said, and this is a quote, "It was a good half. We've moved on." I asked him what he meant by that.
Well, we're looking forward, and unlike most companies that are in a sort of relatively steady state, where they're growing by 5 or 10% a year, and maybe if they're lucky 20%, as you'll see, we're growing at on average above 60% for the world. But in the rest of the world outside the USA, our growth in Western Europe and UK and even in Australia and New Zealand, for that matter, has been in some countries north of 100% growth. So, great result, fantastic, 60% up. But we're looking forward that we're not resting on our laurels. There's more low-hanging fruit for us geographically, and there's more low-hanging fruit for us by getting our salespeople to go further down into the hospital bowels, out of burns, out of wounds, and into diabetic foot ulcers and venous leg ulcers and oncology and so forth. So that's a long-winded way of saying we're just still trying to kick some goals.
Right. Well, you saw a 5% increase in sales driven by the opening of new hospital accounts. So what is driving that? Is that effective marketing? Do you have, ace salespeople, really good relationships? I suppose I'm wondering if that level of growth in those hospital accounts is sustainable.
If you think about the fact that we didn't have a product or revenue 5 years ago, and now the analysts are saying we're on a run rate of 100 million a year, but we're growing, more or less month on month, then there's more to come. But what's driving that growth? Well, we've got a technology that's really disrupted the way in which surgery is done. It started off by doing Bali bombing and New Zealand volcano and Greek volcano and things like that. We've made our name on that, but it's much, much more than just a burns company. So this is a company that's displacing many of our competitors who don't have a product like ours. Most of our competitors have a product that's made from animal gut, whereas ours is a synthetic foam and inert, which has certain advantages in terms of wound healing and so forth. So, look, the thing that's really driving it is we have a gun sales force. Don't worry about that. And I think in the US alone, we've gone from nobody 4 or 5 years ago. I think we've got about 80 people on the road and another 40 or so in the office. That probably should be 100 pretty soon. And each person we put on covers a different area and different hospital system and so forth. But the surgeons really want to use it, and the surgeons are driving it as much as our gun sales force. In the last 4 years, but probably we've had something like 230 refereed journal articles in journals put in there by surgeons, often without our knowledge. The surgeons love it. They want to do some experimentation with it, and then many of them want to write it up for other surgeons. So we're getting calls from places we don't even have people on the ground saying, I want the product. I want the product. We sold the big order just 3 weeks ago now to Abu Dhabi, for example. Big order into the Ukraine, big order into Turkey, and these are places where we really haven't gone and marketed ourselves.
So when you consider that growth that's happening, not just in the US, I think sales growth in the most recent half in the US was close to 42%. Rest of world was 122%. I know you just had an announcement about growth in India as well. How, though, do you maintain margins when you've got that type, of global expansion happening?
Well, the margins are very high. So that's the first thing wherever you are. And starting off with a very high margin means that we do have the ability, if we need to cut our cloth and to, put product in either for humanitarian reasons or to meet the market wherever we are. So, we don't necessarily charge the same price in parts of India. And certainly we just sold a very big order into the Ukraine, paid for by another government and a charity, but we didn't charge full belt on that, but we still made a very handy margin because of it. So I think the point is that if you've got a very handy margin, then you can cut it a little and meet the market or be much more generous from a humanitarian point of view.
When it comes to staying ahead of your competition, which you've already referenced is really important as well, how do you balance that growth, margins, profitability versus R&D spend? Because some in the market say that investors have become just too overly optimistic about PolyNovo's, the extent of what it costs, to stay commercially competitive.
The growth you're seeing at the moment is really growth on our core product, and that's it. And how do we get more growth? Put more people on the ground, visit more hospitals, go into new jurisdictions, etc. And there's plenty of upsides still to be had out of that. We don't need new products in order to keep that growth going in the near term. Having said that, we're spending quite a bit on R&D, a lot less, by the way, in percentage-wise than many of our competitors. But, we would have, I'm guessing now, 14 or 15 people in R&D in Melbourne, and they're working on things like breast implants, hernia, and so forth. So we've got a foam that is largely being put on the outside of the body. We know how that works. Bind a wound up, put our foam on top of it, come back in 4 weeks and the foam's disappeared and your dermis is rebuilt better than when you were a baby. That's our product. So we know how that foam works. So the idea, let's say with breast is, and everybody knows the problems that people have had with breast implants in the recent past in terms of bursting and moving and so forth. The idea, though, is to take a pocket, like the pocket of my jacket, made out of our foam, very thin, no thicker than our shirt, plug a breast implant in there, sew it in, and as the foam, which we know disappears, over the next 4 to 6 weeks it'll disappear, but when it disappears, it integrates with the local tissue. So it holds the breast in place. So look, we've got, there's a half a dozen things that we've been doing on our own that are all, $8, $9, $10 billion markets. Hernia and breast are that, but there's others, rotator cuff for men and so forth. So there's plenty that you're going to see come out of us in terms of noise in the next 2 years, and hopefully even sooner with some of those products. On top of that, as I've said, we've got surgeons that are trialing it on things that we're not even aware of, And just recently I told the story. There was a Friday night conference in Germany, and a surgeon. The first speaker was a woman who had a client who was pregnant, 6 months pregnant. They observed the baby, and the baby's spine is not covered. It's going to be born with spina bifida, in other words. The woman that makes a decision to go in utero with a tiny piece of our foam, probably no bigger than one of your fingernails, and tacks it onto the bottom, the back of the baby. The baby's born 3 months later, spine's covered, go home. Well, can you imagine if you're one of the 30-odd surgeons sitting in that room in Munich and hearing what people are doing inside the body? I mean, even for us, it was like, holy moly, that's what we are going to do, of course, with rotator cuff, with breast implants, with hernia and so forth. But to see what some surgeons are doing off their own steam is breathtaking.
You've got some good lines. You've also said in one of your communications with the ASX that you view profit as a nice to have. That's a quote. Can you explain that for our investor audience, which are trying to assess companies that are growing, but with profitability as a focus? What does that mean, that profit is a nice to have?
If you're sitting in Silicon Valley, the tech companies now widely use a valuation methodology called Rule of 40. And that is that you ought to be growing by at least 40% a year, adjusted for profits or losses, depending on how you go. Value is getting, and there's some now quite good studies mapping the share price of all the listed tech companies against this Rule of 40, and it's a beautiful fit. And I think it's as much relevant for growing biotech companies as it is for growing tech companies. In other words, the market and I are, focused only on growth, and by growth I mean sales growth. Because when you have a margin like us, and I said, listen, I'm not interested in profits. Okay, of course I am, but I said it slightly tongue-in-cheek, because with our margin, people can see that very soon, and you saw it in the half-year release, we are going to be profitable. So if I can spend $10 million this year and go from 100 million sales to 200 million sales, I'll do that every day, as opposed to not spending that 10 million and making $10 million worth of profits. So it's a relativity, and my relativity is concentrate on the sales, get into more hospitals, deeper into each hospital, and get into more geographies and deeper into the hospital systems and the geographies. So I did it, as I said, tongue-in-cheek, but I also just wanted to be mischievous, to be honest.
Mischievous David Williams, the chair of PolyNovo PNV, which some would say is a bit of a market darling. But there are others that cast a bit of shade on whether it will be able to commercialize, grow internationally, spend on R&D, and maintain or grow margins. You?
We think it's a really strong business that we've been involved in for a while now. The stock price has been doing exceptionally well just recently, almost up 100% from the lows. It's another really good example, similar to Life360, where they're focused on growth, they're focused on revenue growth, but can very easily be profitable. well, I think both of those two last guys are just really downplaying the ability to get those profits. So it's the total opposite of companies that are not able to make that shift. So yeah, I mean, he's still focused on delivering those exceptional revenue tick ups. I think 60% for the last 2 half years, year on year, really strong. And I think it's they're investing a lot of money. Like you said, if you can spend 30 to do an extra 100, and this technology we believe has actually got the ability to get that. They're just like Life 360. They believe that they've just scratched the surface of the market. So will very quickly grow, and the earnings will take care of themselves. They can quite easily have those profits. He talked about it just then. It was about $5 million in net profits that he, somewhat casually just, printed.
Yeah, well, that's not huge money in fairness, but what is interesting is that, there's nuance when you're talking about this concept of profitability. You really need the sort of expertise to figure out, the growth potential versus money being spent, etc. So I know we're going late, but I think it's worthwhile. Just in the interest of time, I will note that you do hold PolyNovo in some client portfolios.
Yeah.
And I will say, Josh was a little bit modest, that they did buy Life 360 at Maqro Capital on behalf of clients day before the result, correct?
Yeah.
You're pretty happy with that?
Yeah, very happy. Clients were too. So.
All right, well, I think that takes us to a next audience question, which I'm going to, again, in the interest of time, use it to get into some of Josh's recommendations, I suppose. This is from Nev. Hello, Nev. Thanks for watching. He says, do you have any recommendations on companies expected to be cash flow positive during this or the next reporting season? I'll expand it out to say, with this whole growth trajectory, path to profitability theme in mind, what companies do you like?
Yeah, there's a company that just very recently has started to make the shift to that profitability. Again, like I mentioned before, that are on the cusp of doing it right now. So for example, SiteMinder. It's a company that services hotels. They were able to reduce their net loss from about 15 to the most recent print being 1 mil loss. And they just also gave guidance that will be earnings positive. So the guidance is there that will be earnings positive moving forward, pretty much from the report the day on moving forward. And the company was recently just added to the ASX 200 as well. So modest share price boost on the back of its report and being added to the index. So I still think there's a lot of value in the upside, that one too.
Okay, so that's SiteMinder, SDR, and I've got to say the brokers love this one as well. If you can get your hands on any broker reports, of course, do your own research, which is the general rule of thumb across the board. Another one, which we tried to get for this event, it just didn't work out, but we've spoken with them in the past on ausbiz.com.au, is Findy. So this is a company that is a fintech, the name implies, very focused. Is it primarily the Indian market or exclusively the Indian market?
Yeah, I think exclusively in the ATM, sort of assets that they've got there. It's a company that has really, its sort of earnings have been hovering around the sort of break-even level, but they've recently just had a massive uptick in revenues and more expected to come through. So that's a company that definitely from a revenue point of view is really growing quite strongly, but we would also expect that to flow through to the earnings, having a lot of fixed costs and then that massive revenue uptick, it's all going to go to the bottom line.
Another company that I saw was on your list is Hansen Technology. Now, it recently made an acquisition called Power Cloud. Wouldn't that be a bit of a cash burn scenario as it looks to integrate, bring that in? So why is that not a bad thing?
Well, they've been cash flow positive for a long time now. They're not a new company that's made this switch. So I thought I'd just include them to have a little bit of stability in terms of the earnings. So we're not just picking that one particular strategy. But yeah, look, they've constantly been a really strong revenue grower. Their earnings have always been really consistent in terms of the numbers that they've delivered to shareholders. Founder-run business is a great sort of thing, but it goes back to the point that I made before. There's spending, and we don't want companies to just cut costs for the sake of cutting costs. The PolyNovo CEO put it well. He goes, "I'm not going to just print $10 million profit for the sake of it when I can be putting that to growth. So this is an example of a company that has done an acquisition to grow its market share. So it's going to be able to grow from that acquisition, bring that onto the business, have those synergies. It's going to be earnings accretive, so you're going to get further earnings from that, even though it is a purchase. And then you know from there, it's going to be a company that just continues on those really strong growth in revenues and earnings as well.
Okay, so Hansen Technologies is another. So another tech company, interesting. That's just the nature of the beast, correct? Share price is up 11% year to date. So what is Objective Corp doing right? Because we talked about this one on AusBiz with a few expert guests a while ago, saying that so many people see potential in this one, but it's not really proved its mettle yet. Yeah,
I'd probably put this more in the turnaround category. Its share price has been somewhat similar to a Bravura, where sort of been heading down with the market and this sector for a little while, showing signs of life again. So this year up over 10%. But yeah, they've got some really good sort of earnings that are going to continue on as well. It's an area that we think is going to be an expanding subsector as well. So I think that's important.
What does it do again, just for?
So Objective Corp, they're involved in a few different areas.
Yeah.
So it's in the tech space as well, but it's one that we really like. And there's a lot of these tech spaces, so I thought we'd include one that's a little bit different. Outside of the tech space, I thought I'd include Boss Energy as an interesting one that's going to have positive earnings and positive revenues to come through. Obviously, it's been negative revenue and negative earnings with a lot of cap raises, but as they finally go into production, it's one that we see those earnings come through. And similar to PolyNovo in the biotech space, it's one that really makes an investment grade for us now that it's going to get those revenues and earnings to flow through to investors.
Okay, so one from the resources space as well. So I'll run you through the list again. That was SiteMinder, Findy, Hansen Technology, Objective Corp, which is just in the software business. I shouldn't say just, but it's in the software business, and Boss Energy, uranium. So there you go. Josh, thank you. Huge thanks for that. I'm just wrapping it up for time. Of course, you can reach out to the Maqro team if you have any questions further about any of those companies just recommended there. It's where we're going to have to end this virtual investor event. A huge thanks to all of our guests, the CEOs, chairs, and of course, as I mentioned again, Josh and the team at Maqro Capital. Thanks to you as well for watching. Look, I know we didn't get to all the questions, but I do hope you've come away with something. And we do hope you can keep your eye out for the next AusBiz virtual investor event. In the meantime, we'll see you on ausbiz.com.au, and I hope you have a wonderful day.